Good evening, everybody. My name is Ian Shepard, and I'm the owner of Right Start Newcomer Services. Welcome to our weekly Settle in Canada live stream. So we've got another great show tonight. Tonight, we're going to be talking about planning for retirement. So thank you so much for joining us. Please tune in. We have a great guest speaker. But first, before we get into today's live stream, I would like to acknowledge that Right Start Newcomer Services conducts business in Chibuktuk, which is how you say Halifax in the Mi'kmaq language. This city is part of the ancestral unceded territory of the Mi'kmaq people. This means that when settlers came, the Indigenous people did not surrender their territory and instead signed treaties with Europeans. As a business, we're committed to upholding these treaties as we continue to build relationships between settlers, newcomers, and Mi'kmaq people. Great. So if you're tuning in, say hi in the comments section. If you have questions throughout tonight's live stream, please ask them. And now I'm going to introduce tonight's guest speaker. So tonight's guest speaker, his name is Qi Zong Wu. Tell me if I pronounced that wrong, Wu. So originally, he is from Guangzhou, China. He's lived in Nova Scotia since 2005. He earned his bachelor degree in finance and marketing from St. Mary's University in Halifax. He's been working in the financial services industry since 2011, so he's got lots of experience. And he received the CFA, which stands for Chartered Financial Analyst, designation in 2018. So I'm going to bring Wu on. Hi, Wu. Welcome to tonight's live stream.
Hi, Ian. Glad to be here. Really excited about the event. Just sharing what I know with everybody.
Yeah, great. So you work for IG, which stands for Investors Group. Can you tell us a little bit more about yourself and the company?
Yeah, sure. So like you said, I've been here since 2005, and then after I graduated at St. Mary, I worked at different financial firms. So the first one I worked at is at SICO. So it's a hedge fund accounting company in the city. So what I did there is basically exposed me to a lot of different investment strategy. And so I got really interested in them. And at that point, I really wanted to know more about how the idea is generated and how portfolio management works. I spoke to a couple of friends, so most of them recommended me to pursue the Chartered Financial Analyst designation. So that's what I did. Eventually, I realized the role that I'm doing with the company. The experience didn't count towards the CFA work experience. So then I started looking elsewhere in Nova Scotia to gain the work experience, just similar to some people that pursue this chartered public accountant designation. So then you have to pass the exam, and then the second part you also have to have the work experience. So I like SICO, the company, a lot. I learned quite a bit there, but at the end of the day, I wanted to get my CFA designation. So I left, and then I went to one of the big six banks in Canada and worked under their wealth management unit. So there I learned from another. I was lucky enough to learn from another CFA charter holders. So I learned it from him how to build portfolio, how to do investments, and then at that role also exposed me to all the different saving accounts that I didn't know until I was in the role, even though I was in the financial industry. But at that point, I wasn't thinking about financial planning. I didn't know what a tax-free saving account or a registered saving plan is, which we will cover tonight. So then I began working with people and then help them come up with strategy, and then I find that the experience was really rewarding. So then I want to find a way that I can push the service to more people, and because at that time the service only provided to people with a certain amount of asset, but my experience and then my thought process was that if people know those techniques at the earliest stage, they can actually benefit them most, and then they can save a lot of time and reduce the stress as well. So then that led me to IG. So IG is one of the biggest non-bank affiliated wealth management firms. So then pretty much they're doing the same thing, but we're not. So we're not with the bank, and then so what allow me to do is actually just provide unbiased recommendation to people. I just sit down with them. I learn about their circumstances, and then I was able to come up with a solution, and then I can just pull things that the company have access to a lot of resources. So then what I really do, I just pull things that meets their situations, and then I can give them unbiased advice as how I can help them with the goals that they had in mind.
That's awesome. Yeah, great. So yeah, you brought up a lot of things related to what we're going to talk about tonight. So, like you said, it can be confusing. There are a lot of terms like TFSA and RRSP and all of those things, which can be very confusing for newcomers. But that's why we're here tonight. We're going to talk about those things. We have a presentation set up that Wu is going to go through. And definitely, if you have any questions, please ask them, and we will address them as we go through tonight's presentation. So I just want to say hello to some of our viewers. Elena is watching. Hi, Elena. Hope you're doing well. Elena and I used to work together at ISANS, which is the Immigrant Services Association of Nova Scotia. So, hey, Elena. And Jesus is here too. Hey, Jesus. How's it going? Okay, good. So thank you guys so much for joining. I'm going to add the presentation. Just give me 1 second. And okay, here we go. So I'm going to put Wu up top. All right, Wu, whenever you're ready, let's go through tonight's presentation.
Yeah, sure. So tonight I was going to talk about all the different saving options that you can use towards retirement. Most of the information about the other registered account that we talk about, you can actually just go on the CIA website and then just use the search button. You can pull up a lot of things. And my goal today is just a brief introduction of what these different saving accounts are, and then just so that you're aware. And then a lot of time depends on your career path. You might not have all of them. So then that's the thing that and then how they. So then you will know in the future how to can work with each different plans.
Yeah. Just to explain for everybody, if you're not aware, CRA stands for Canada Revenue Agency.
Yeah.
So that's the tax organization from the government who collects our taxes, but they also give information about retirement savings.
Yeah.
Okay, great. Let's move on to the next one.
So the first one, I think we all hear about, and once you open a bank account, at some point you will be introduced into this registered retirement saving plan. So what is short for RRSP. So what it does is, so first of all, when you put money in it, one of the things they talk about is you can get tax refund. I think there's a lot of people interested about. So what happened is how that works is essentially if you make, let's say you make $10,000 for simplicity's sake, and then you're able to put about maybe $1,000 into the RSP account. So instead of paying taxes as you make $10,000, you're only paying taxes as you're making $9,000. So that when you put the money towards the RRSP, it will help you reduce your tax liability at current year, and then in the future when you take them out, and then you will pay tax at that point. So the reason of the rationale of that is really we're thinking we were building our career, we started making more and more money. So then when you put the money away as you're making more money, and then help you reduce your taxes, and then in the future when you retire, you're probably not going to be having as much money as you during your working year, and then at that time you will be in a lower tax bracket. In Canada, there's a tiered tax system. So the more you make, and then the more taxes you pay. So RRSP system can actually help you balance out the effective tax rate. So that's the concept, and then sometimes I can help. Maybe I will use a couple examples in the future just to show how that works. And then so once you have a RSP, what you can do is you can, when you put money in it, you can actually buy stocks, or you can buy something like a guaranteed income certificate and things like that. And then so when you make money from those type of investments, you don't have to pay taxes on those things. So the contribution room. So then another question will be, so how much money I can put into this type of account, and then that will really depends on your earning income. So if you work in Canada for employer, at the end of the year you will get a form called a T4. So on the T4 it show you your taxable income, and then your contribution room is 18% of the earned income, up to a maximum amount. So for 2021 is up to 61,600. So for example, we use about the previous example that I used. So let's say we make $10,000. So how much I can put in to the RSP this year is 18% of that $10,000. So that will be 1,800. Sorry. So that will be 1,800 that you can put in, and then you that amount goes, and then it stops when you're at 61,600. So if you're making 70,000 in this case, your contribution room will still be calculated as 61,600 times 18%. So this plan, so eventually they want you to fund your retirement, so you have to start taking money out. So when you turn, you can keep the RSP account open until you turn 71. At that time, it get mandatory. It's a mandatory conversion, so you will have to convert your RSP into a registered retirement income fund. So then the government also have a percentage how much amount you need to start taking out from the account to fund to help you fund your retirement. And then at that point, when you take the money out, those money inside your account will be, the amount that you take out that year will become taxable.
Great. So we do have a question, but before we get to that, Wu, I think there could be a typo in your slide. So the amount 61,000. I think it's 161,000.
So at the third point, you mean the 61?
No, the second point. Instead of 61,600, I think it's 161,000 maybe, because that amount seems pretty low.
That's the I pulled it out from the website, from the government website. So that's the amount. So then but that's for this year. So each year your room can accumulate. So if you don't use it this year, so because maybe you have more things to do and then you use more money, so those room can get accumulate. So back to if the 10,000 is easier for the math purpose. So if you're 10,000 and then this year you get 1,800, and then you didn't end up putting anything in it. Next year you make another 10,000, and then you get another 1,800. So then now you have 3,600. You can so then you just whenever you have time you can put the money in. So then your room can get built up in that way.
Anyway, we can talk about that later. I just want to say hello to a couple people. So Abdullah says hello. Hey, Abdullah, so good to see you again. And Elena does have a question about her RRSP. So Elena is asking, can I use my RRSP to buy a house? Is it right that I can use this home buyer program every 5 years? Oh, that's a good question.
Yeah. So the next slide, so which we will touch up on, is the first-time home buyers plan. So yes, you can use your RRSP up to, I believe, is $25,000. You can take it out without having that money count towards the income that you're making that year. So then basically, if you have 50,000 saved in your RRSP account, and then you want to use 25,000 for buying a house, because under normal circumstance, when you take $25,000 out, that money will get included in the taxable income for that year. But if you use the first time home buyers plan, that won't count towards it. And you have, so it's when you buy it, like for example this year, and then the first time you have to start, it basically is a loan to yourselves, but then you have to pay it back the money that you take out. So it will be over 10 years time. You have to pay back the 25,000 maximum. So if you buy it this year, I think it's you have year and a half, then the repayment schedule starts. So it would be at 2023, you will have to start paying at least 2,500 a year. If any time you didn't meet the 2,500, the difference will add it back to your income tax that to your income that year for tax purpose. So can I use the home buyer program every 5 years? No, once you use it for the first time, that's why you call it first time home buyers plan. So once you use it first time, you won't be able to use it again.
Yeah. So yeah, I agree with that. So Elena, no, generally no, you can't. I did hear, Wu, that if say somebody uses it once and then they don't own a home, so maybe they buy a house and then they sell the house and they don't live in a house for a period of time, then they might be able to do it again. But it might be 5 years or 10 years that they didn't own a home. Have you heard that before?
Haven't come across a case like that just yet, and that might be it. And I'm not familiar with that, but I can definitely look into it, and then maybe I send you an email after I find out the information, and then you can pass along to Elena in that case.
Sure. I'm going to put Wu's email up right now. So Elena, if you do want to contact Wu directly, I'm sure he'll be able to find the answer for that question. So it's qizong.wu@ig.ca. And I'll put that up again later at the end of tonight's presentation. Great. Thank you for your question, Elena. And Bay says, hi. Hi, Bay. How's it going? Good to see you again. And Elena says, thank you. So you're welcome. And thank you for answering that, Wu. So no I think that's it about RRSPs. So keep in mind that not everybody might have an RRSP. This is just one account or one way of saving for retirement. And Wu is going to talk about other ways in a second. Okay.
So then the next one, another one that's quite common is a tax-free saving account, so a TFSA. So in this case, contributions are not tax deductible. So the money that you put in to a TFSA in the current year won't reduce your income tax. But then another thing is different from RSP is when you take money in from the RSP in the future, that money get added to your income at that year. But for TFSA, that when you take the money out, it doesn't get added back to your income. And so and the capital gain, so if you buy something, you buy a stock, and then it go up, and then you make money out of the stocks, you don't have to pay taxes on it. Dividends, interest can be a little bit tricky, depends on the stock that you buy. So most of the time, if you buy a Canadian company on a Canadian exchange, you'll be fine. But if you're buying a stock that may be traded in a foreign security market, then that might be, you might have to pay some taxes on it. So that will be something to keep in mind. So the contribution rule, instead of determined by how much you make each year, it actually is set by the government. This year, the contribution limit is $6,000. So if you you are Canadian, or you have a SIN number, or you are permanent residence, you file your taxes. You have to file your taxes so then the government have a record. Then you will get the 6,000. And then if you have been here before 2009, and then you haven't actually looked into a tax-free saving account seriously. So if you haven't done anything with it, and then right now you could eligible for the whole $75,500. So if you had that sitting aside somewhere, and then you can put it into this saving vehicles and then enjoy the tax exempt benefits.
Great.
So one thing is that because the treaty that we signed with the U.S. government, a tax-free saving account is not a tax shelter in the U.S. Unlike the RRSP's account. So that mostly apply to people that maybe have a green card from the U.S. or they're dual citizens. So if they're dual citizen, normally we don't recommend them to open a TFSA account in Canada because they will still have to pay taxes in the U.S. and then a lot of time we don't keep, because in Canada it's tax free. We don't keep a lot of paperwork to help the people with the U.S. So when they file the U.S. taxes, that can be a little bit tricky. So we're going to touch on here similar to RSP. So if the government say you can only put $6,000 a year, and then that's all the room you have, but you purposely put more than what you allow. Because we didn't know, a lot of time you have the information, you can find the information when you sign up for your CRA account, or when you file your taxes, you get a notice of assessment. It will tell you, you will know how much you can contribute, but we don't have a record of that because of privacy concern. So then some people will try to put maybe more than they're allowed to. If they over contribute, sometimes you will have a chance to withdraw it, but if you don't, if you're only allowed to put 6,000, you put 6,600. The $600 would be taxed. You will have a penalty of 1% every year until you take it out. So that's something to be they should think about. And yeah, so then so to help people save some of the tax benefit here will be like if something happened and then you have a spouse that the balance can transfer over to the spouse, and then they can continue to use the room that you have accumulated plus they have. So that's a good saving tool just for estate planning as well.
Great. Okay, we do have another question from Elena. So what is the main difference between RRSPs and TFSAs? So this is a very common question. So what are the main benefits of one over the other? And Elena doesn't see a big difference. So can you explain that, Wu?
Yeah, so basically what if you think that we think about when as our career progress, we're going to make more and more money. And then, like I said, in Canada, we have a tier tax system. So the more you make, and then you have to pay more taxes. But if you think that if you manage to have a stable income throughout your lifetime, throughout your working life, then that difference is not that much. But if you're making like 30,000 now, but then in the future, as you progress in the company or progress in your career, you can be making like 70 and 80,000 a year at later in your life, and then the tax bracket you all of a sudden going from somewhere between like 20 some percent, all of a sudden you're up about like 30 close to 40%. So in that case, when you're in a higher tax bracket, it's better to put your money, better save your money in the RSP, because if you make, for example, you make 80,000 this year, and then but in your TFS in your RSP you have $10,000 contribution room, so you can put $10,000 saving into the RSP. All of a sudden, instead of paying 40% on a $80,000 income, so you're paying something like 32, yeah, 32,000. That could be your tax bill. That could be your tax. But if you put $10,000 in, also then you pay 70,000 times, let's say 40%. You're still in the same tax bracket. So all of a sudden, instead of paying 32, you're paying 28,000. So then you save that $4,000. So that $4,000, then you save. You didn't, and then you can put it to your TFSA, or you can, if you, after you file taxes, you have more rooms in your RSP now, you can put it back again. And so then that would be the cases where make more sense to put your money in the RSP instead of a TFSA, because if you have $10,000 in a TFSA account, contribution room, you put it in it, you don't get you don't reduce your taxes this way. So then when we help people to decide whether they're going to put money into RSP or a TFSA, we will look at the income potential and say, well, you're probably going to pay more taxes in the future, so you want to save those rooms. So you don't want to contribute to your RSP now, because you can use those rooms in the future when you're in a higher tax bracket. So then maybe in that case, we will recommend people to contribute and use the TFSA first, and then if they have more money, then they can look into putting into a RSP. So things like that. So we really just work with each individual case to see to come up the best strategies.
Great answer. Yeah, so there are a few differences, but I think they're both good, right? It's good to have a TFSA and it's good to have an RRSP. RRSP can save you tax money when you make contributions, but remember, when you take the money out, then it will be taxed in the future.
Yeah. So so you use them. You use the two combine and then effectively can help you smooth your tax rate out and save more money that way. And then I think a lot of people didn't think that they were the same, because both of them, the money inside is grow tax free, but it's really how you can use it to help with your tax rates, the money that you make.
Yeah. Elena has a great comment here. Great. I just need to have a job at 80,000. Well, you mean Isanz isn't paying you 80,000 yet, Elena? You've been there a long time. You should ask Maria for a raise.
Well, I just like to use round number, but really, if you can, anytime you can see yourself in a higher tax bracket, you typically you can just use the same strategy too. So then you can save your contribution room now for the future to help yourself lower the tax bill in the future.
Yeah, exactly. Okay, great. So thank you, Elena. Thank you for answering that, Wu. I know we have some more slides. So here's the next slide.
So a defined benefit plan, so commonly known just as a pension. So they're not everywhere these days, because some of the liability issue that can go on the company. So then, but for if people working in a government or working at the university, they will likely get a company pension. So the pension. Just so then you work for the company so many years, and then for the promise that when you retire, the company will pay you a series of cash, like monthly cash, that help you when you during your retirement until you or your spouse die. Some of the pension have a survivor benefit, so then they will cover both of you. So the payment, how much you get paid, that will be different from company to company. Is really based on the design that the firm and then the pension management company, they work together to come up with the design. So I can tell for sure how much you can make, but once you work and you're entitled to a pension, every year you get a pension statement, and then they would tell you, they would do the number for you and let you know if you work so many years, and then that's how much you will have when you retire. So then they would tell you. So because it's one of so the money that you put towards your pension, that will reduce your RSP contribution room. So the money that put towards the pension, again, at the end of the year, you will get the tax slip, the T4. So on the T4, will show you how much you make, how much you put towards the pension, and how much RSP room you had, and then could accumulate without the pension, and then because the money that you already saved in a pension, then they will reduce your RSP room. So go back to you make $10,000 if your company mandatory put about $1,000 away for you automatically. So instead of have $1,800 in your RSP room, because you already put 1,000 away to your pension, so now you only have $800 left.
Yeah, makes sense. Okay. Now another plan.
Another one. So that's another group saving plan that people typically get from work. That's the more common one nowadays. So they will get a group saving plan called a defined contribution plan. So the design is pretty similar to a RRSP. So the money you put away can help you reduce your this year's tax bill. And then a lot of time, the company will have a matching program. So the job that I used to have, they go anywhere from 5 to 6% of the money that my income. So if I decide to put 5% of how much I make into the plan, and then the company will match, they will give me the same dollar amount. So if I make $10,000, put in 5% away, so therefore $500, and then the employer will automatically give me another $500 to go help me save. So a lot of time those one are done with insurance company. So then the investment, instead of like RRSP and TFSA, where I talk about stocks and stuff, in those type of plan, when you're with the company, you most likely only you can only invest in mutual funds or segregated fund. It basically is a mutual fund that wrapped in an insurance contract. So then the insurance company can sell it.
Okay. Great. We do have another question from Elena. So Elena's asking, is it right that if I died, my spouse will receive my pension every month?
Yeah, if you have a survivor plan, benefit in your pension, and that will be the case.
Mm-hmm. What happens with an RRSP? I'm not sure if Elena's asking about RRSP or defined contribution plan or what, but what happens with an RRSP?
Okay, so so with pension, so then once you die, you have a survivor benefit, and then they will pay your spouse until he or she passed away too, and then there's nothing left. But with a RRSP, if you both spouse doesn't both of them don't use all the money, and then the leftover can be send it to the after they pay the estate taxes and stuff, whatever leftover it can be left to the second generations.
Okay, so it could go to the children after taxes and stuff are paid.
Yeah,
or the
children, or anyone like that. They will have to designate a beneficiary, and then the money after all the taxes, and then it will go to the beneficiaries.
Yeah, great. So yeah, you could have somebody with multiple spousal pensions or survivor pensions. So if I got married and my wife died, and then I get her pension, then I marry again and she dies, I get her pension, and then somebody else dies and I get her pension. So is that possible?
Well, probably haven't seen a case like that, but as long as like when you sign up for the pension, they will ask you who the beneficiary or who the survivor benefit paid to and all those things. And so so if that would be some concern, then definitely doing a estate planning analysis will be warranted. Like they might want to look into that.
Great. Okay. Thank you, Elena. Hopefully that answered your question. We're moving on to the next one.
So lock-in retirement account. So that's what they are called in Nova Scotia. So it's short for LIRAs. So, and if they were outside of Nova Scotia, I think Manitoba and BC or Quebec, they might call it differently. Basically, it's a type of account that's regulated by the provincial and federal pension legislatures. Depends on the nature of the employer. So if you're working for the big six banks or you're working for the government, federal government, you might fall under the federal pension legislature. But if you work for just any company like that just domicile in Nova Scotia, maybe they will fall under the provincial pension legislatures. A lot of time you will know when you sign up, and then you get the brochure. And so then the most defined feature of this account is that you have limited access to the money that you put towards the account. So when I look it up earlier today, just to refresh my memory, so the age limit is 55. So I personally have a lock-in account. I have about $30,000-$40,000 in it, and then sometimes I wish I can use it, but then it just sit there because they want to protect me, make sure when I'm older I have money that can help me a little bit. So then they're gonna just sit there until I'm 55, then I can take the money out. So similar to the RRSP, when you turn 71, you will have to change the account into a retirement income fund, but different from a RRSP. In this type of account, you have a maximum amount that you can take each year and a minimum amount that you can take each year. From the retirement fund that comes from a RRSP, you have to take out a minimum, but they don't set a maximum, so you can take as much as you want. So that's the difference. So how you will end up with a lock-in retirement accounts, you can either when you leave your work, and that where you either have a pension plan or you have a defined contribution plan that we discussed earlier, you can take them to other financial company, and then when you move them, then normally the result would be a lock-in retirement account.
Okay, so yeah, from your old job, you have one that's locked in until you turn 55, and you can't take it no matter what.
There's some really dire circumstances you can take them out. So they have free that they on the website is when you have financial hardship. So then something like if you don't have the money, if you don't pay your house mortgage or your rent, you can get kicked out, and then that will be the time where they might let you have access to it. Or another case is if somehow I wasn't diligent with my investment, because this account, when you take it to other financial institution, you can start using it to buy stocks and other investments. So then if I didn't manage properly, I might send the account down to below $20,000, and then in that case you might be able to take it out. And then the last one is when you're really sick, and then you can get a doctor's note that say your life expectancy might be less than 2 years, and then in that case they might let you take it out as well. But that will be the free cases where they might let you to take the money out earlier than 55.
Okay, great. Yeah, I know we're getting a little short on time, but there's a couple more slides to go through.
Yeah. So and then another, the OH security. So this is one that coming directly from the government. You don't have to do anything to qualify for it. All you have to do is just be 65 years older, be a Canadian or a permanent resident. So and then another requirement is you have to be in Canada for at least 10 years, for at least 10 years since you turn 18. And then each year the government will announce how much that you can get. And then sometimes when you make too much, there's a thing called a clawback. If you somehow manage to have too much money, and then because it's a social benefit, they only want to, they're designed to help people that less unfortunate. So then if you are able to afford your retirement comfortably by yourself, and then the government typically have have level where if you're over there, then your benefit will start getting reduced up to a point you don't get them anymore. So part of the planning when we're doing retirement planning will be overlook. We'll be helping people like look at the numbers and then determine the source of their income. So then one thing will help them to just say, well, you might because the money that we take from RRSP and then the LIRA can be taxable income. So then in that case, well, you might not want to take too much money from those accounts this year. So then you will experience a clawback. So in that case, if you have money in a RRSP, in a TFSA in your retirement, so at some point maybe it's good to just take money from a TFSA instead of RRSP, because money taken from the TFSA doesn't count towards your taxable income. So that can help protect your old age security benefits. So that's maybe back to earlier thing. One question that Elena asked, and then that would be one of the things that the TFSA can help.
Yeah, great. Okay.
And Canadian Pension Plan, CPP. So the contributions, if you work for an employer, when you get your pay stub every couple weeks, you see it showing on your pay stub that are coming off from your paycheck. So automatically, it's 10.9% for 2021. I looked at the website earlier today. So then again, it will be have to mention earlier. We mentioned the year maximum earning 61,600. So then that would be the maximum you have to pay is 10.9% times that. That would be the maximum that you have to pay. So so if you're working for someone else, you and your employer will each contribute half to the CPP. But if you're self-employed, then if you want to participate in the CPP, you have to pay the whole 10.9% yourself. The most common question I get from people is, so how much will I get from my CPP? The best way to do it is actually you can go online and then Google search the CPP calculator, and then we'll take you to the government website, and then you just have to have your tax information ready, and then you fill out your tax information, and then they take you there. They will help you estimate, and then that will be the best number that I can give you.
Yeah, great. We do have another question from Elena. So she asks, how much is too much? So I think she's referring to the old age security question. You were saying that if your income is too high or too much, then they claw it back. They take some of it back. So maybe what is the level that they start to take back the old age security payment?
Okay, so I think on my slide, I remember the number. If I remember correctly, I think it's when you're over 140,000, something like that, and then at that point you don't get qualified at all. But in between the 70 to the to that 440, there's a formula to determine the clawback amount, and then there's so we will use our planning software, and then they can calculate the exact amount. So I know there's a formula, but then because in practice we just put it in the calculator. So in my head I don't know the exact number, but I know there's a range.
Yeah. Elena, if you're worried about having too much money, it's okay. I can take some of that money off your hands. So just send it to Right Start Newcomer Services in the mail, and I'll take whatever extra money you want to give me. Okay, great. I think this one more slide about CPP.
Yeah, so CPP, so by default, so when you do the estimation, so they give you the full amount. So then the full amount is based on when you decide to take it out at 65. You do have the option to take it at anywhere as early as 60 or as late as 71. So if you decide to take it before 65, there's penalties for each month. If you each month is about 0.6% up all the way up to 30% reduction. And then if you decide to delay your payments until 71, so each month you delay, you get a bonus of added to it is 0.7 percent all the way up to 42% in total to your annual payments. So rather when you should take it down to doing a financial planning exercise and then determine the level of the income you are happy with when you retire, and then we make the decision from there.
Great. Okay. And whoops. So we also have non-registered investment accounts.
So the non-registered investment account is basically pretty much when you already fully contributed to all the accounts that we talked about before, and then you still have money left over, and then typically that will be just in your investment account. It can either be your personal name if you run a business, might also be in your business name. So that in that case, one thing I think just want everybody to take away from this slide is that based on the different things that you invest, they might be subject to a different type of tax. And then, like if you invest in a Canadian company, getting dividend from a Canadian company, the marginal tax will be lower. And then if you just invest in like a foreign company, or you invest in something like a bond, or you just put it in the account and getting interest from it, that will just tax at your normal tax rate. And then if you buy stock, you sell stock, and then the gain that you make, and 50% of that will be taxed. So I think that's on the next slides, Ian.
Yep.
Yeah. So then sometimes maybe you don't. For some years, you might have some bad lucks, and then you instead of making money, you lost some money, and then in that case, you might actually be able to apply that loss to the future or to the years before when you do really well, and then get some sort of tax relief from a non-registered investment account. But normally, we will recommend everybody to maximize their registered account, and then before we delve into the non-registered account.
Okay, great.
Yeah. So the last one, I learned this when I studied for my life insurance license. So some of the insurance policy can actually build in a saving features. So what those policy calls a permanent life insurance. So when you have a permanent life insurance, you decide the amount that you're comfortable to put it away, and then sometimes some of the money that you put away will eventually start building a cash value, and then what the cash value that build in your policy is tax free. But that sounds really good, but then typically it takes about 6-7 years before that cash value to become a sizable amount. So then if you do looking into putting some money away for your into life insurance for saving purpose, you have to plan ahead and then know that there's some money that just you don't have to touch for a while, because if you stop paying to the policy, then the policy can expire, and then you can risk losing everything there. And then normally we're talking about life insurance will be when we're doing a estate planning analysis. So then you have a death benefit on those life insurance policy. So they can be paid to the beneficiary tax free. And then when we're looking about giving saving some money away for the next generation, or sometimes you want to just make a donations, something like that, and then that would be a really great to think about to use it.
Great. And I think we'll probably skip through this if that's okay. Wu, I know we're running out of time, and I think you covered that anyway.
So this one is just earlier when I talked about the tier tax system. And then if you just when you go on your Google webpage, you just use Google EY tax calculator, and then they have a slide there that you can just bring up, and then basically they tell you this is the tax rate in Nova Scotia. And then one thing to take away here, just the more you make, and then you can see your marginal tax keep going up. So then that's why a combination of RSP and TFSA can help.
Yeah, great. So I think that's it for the presentation part. So great. So if you have any other questions, now's your chance to ask them. We'll stick around for a few more minutes, but I want to thank you, Wu. I think you did a really good job of explaining all the different types of pensions and accounts. Maybe we can leave people with a couple of tips. So what are some tips that you would say to people, maybe they're new in Canada, maybe they're just starting their careers here, related to planning for their retirement?
Well, time. I think the more plans that I have done, the more I realize the earlier you start, the higher chances you can get to where you want to be. And then sometimes I think it might be hard because everything's going on and you're new to Canada, and then you just a little bit stressed and then maybe culture shocked and stuff. But I will help people sit down to go through their budgets, and then so one thing when we do budgeting now, I recommend before when we save would be that's how much we make, and then that's how much we spend, and then whatever left over we call it a saving. So then that amount can change over time, depends on what happened during the month. So instead of that, I one thing I learned when I'm doing budgeting for our household is you actually treat the money that you want to save as expenses. So instead of like whatever is left over, you actually put that number into as a fixed expenses. You want to save this, you have to save instead of you want to save. So then that will help you. And then I think essentially that's what pension does, because pension, when you entitled to a pension, the pensioner didn't ask how much you want to save. They just take the amount directly from your income. So then basically you can do that, and then maybe then whatever left over, then you can fit into your discretionary spending instead of treating saving as a discretionary spending.
Yeah, great. Yeah, I totally agree with that. So definitely, I think people should get started right away. So even if you might not have a great job right now, you might not have a lot of money, at least go talk to somebody like Wu and have a conversation with them. They can do some calculations, and you should be able to set aside some amount of money, maybe only $50 a month, $100 a month, maybe, but it's a good start. And as your income goes up, you get a better job or you start a business, then you'll be able to contribute more to RRSP or TFSA or the other accounts that Wu mentioned tonight.
The
other thing that I noticed was people say, why should I save now? Doesn't the government take care of me? And they also say, I'm young, I want to have fun. Why wait until I'm 65 to have money? So what would you say to those people?
Well, I think the government part is just like, why would you leave your destiny to someone else? For me, I like to have everything under my control, so then I can sleep better at night, and then I think that's the thing that I know, because if I plan for myself, I know whatever happens, I can still do like what I want to do. But without planning, without knowing, and then just relying on the government, and sometimes plan change, regulation change, and then all of a sudden that might when change at the time that is not the most convenient for you, and then it could be a little bit too little, too late. So it might be fine for some people, but I think it doesn't hurt to have a conversation to see where you at. Because one thing that we learn from management is about anything. It's your strongest link is the weakest part. Like you're as strong as your weakest link. So I think planning at the end is just really identify what's the weakest link in your life, and then just find way to improve it. And then if you start early, you know where you're going. I've been reading a lot of books about motivation. When you set goals, and then when you have a plan, you can visualize your goal, and then actually help you motivate to motivate what you want to do. Like, do we have time to share maybe one of my personal example?
Yeah, of course. Yep.
Yeah. So like I think I like my little girls, and then I think why not we're saving for her educations when she goes to university, and then like, so if I just tell people, yeah, I want to give her about $10,000 every year for the 4 year that she goes to university, that sounds a lot. And then when we do all the planning, we figure out the math, and then I would ask, do you know how much we had to put away for her to have that $10,000 in about 15, 16 years?
So you want me to guess?
Yeah.
Maybe 2,000 a year, something like that.
Well, a little bit less than that, because we put about $70 every 2 weeks. So it would be 140, so times 12. So that, and then so yeah, so we work out. We don't have to take a big chunk of our budget, but if we start early, we planned it right, and then that's like $70 every 2 weeks. It's not that hard.
Exactly.
Yeah.
Yeah. Great. Okay, so I just want to bring up a couple more comments before we go. So I think I made Elena laugh when I was talking about her sending me money, and Natalia was laughing too. And Elena says, thank you very much, Wu. So great. Thank you for the very useful advice. So you're welcome on my behalf, Elena. Yeah, so I think that's it for tonight. That's all the time we have. Chris says, so nice. Thank you. Yeah, thank you, Wu. And thank you for watching, Chris, Elena, Natalia, everybody else. Thank you so much for all the information. It was really good. So yeah, thank you so much, Wu. Thank you for explaining things very clearly. I just want to share your contact info one more time. So if you have any follow-up questions for Wu, just send him an email. He's a great guy. He'll take his time to chat with you. And when you do get to the stage that you do want to meet with a financial planner, I think Wu would be a really good choice for you.
Thank you, Ian. Thank you for the good words.
Oh, no problem.
And
I've known Wu for a couple of years now. Yeah, we've been in contact. He was volunteering a bit at ISANS, and yeah, he's a pretty trustworthy guy. And, all financial planners in Canada, I think if they have a license, then you can trust them to work on your behalf, right? So they're going to give you the best advice that they can. They're not going to rip you off. They're not going to scam you. So you do want to find someone who is designated. Is that right, Wu?
Yeah. So CFA is one. So my destination is more towards investment, because when I started, that's where my interest was. But then down the road, I realized you have the best investment strategy, but that really depends on circumstance. You have to work around the people's objective. So then now that's why I step back instead of putting too much attention into building an investment strategy. I actually help people set the foundation with financial plans. So CFA is one, and then another one people can look into is CFP, which I'm trying to get myself down the road. And so CFP stands for Certified Financial Planner, and then they also recognize globally. So yeah, and I'm happy that everybody just find it useful, because what attracted me to this role is just really I see there's a gap in financial literacy, and then I just want to do my part with the things I know, and then the more I'm in the industry, the more I realize that it can actually help a lot of people, and then they just don't know where to find information.
Exactly. Okay, great. So we're going to end it there. Thank you so much again, Wu. It was great talking to you and hearing all about investments from you. So hopefully we'll talk soon.
Yeah. Thank you, Ian.
You're welcome. Okay, bye everybody. Thank you for watching.
Good night.